We are live. It's time to get ready for a market melt up. Money printing pivot has begun with Bank of England today. That's why we got that rally today. Bond market's recovering a bit. And of course, Bank of Japan's already been doing this. ECB is likely next. So let's take a look. High risk portfolios up 20.37% total return year to date after returning 233% total return in 2021. This has been a tough year because the Fed has come in and been just destroying the world economy in an attempt to get inflation down as quickly as possible in the US. And in general, the idea has been to collapse Europe and Asia and to make the dollar strong. So this makes all of our imports cheap and helps reduce inflation. And it's working. I think inflation is getting ready to fall, probably top out and fall rapidly into next year. Let's take a look at how we have our asset allocation per unit today. Per unit coming in at $2,089. We have 19 shares of UVXY, the crash insurance hedge, 36 shares of TMF, that's the triple leveraged long end of the US Treasury market. We have 14 shares of EUO, that's betting on the dollar going up against the euro. If the ECB does what the Brits just did, that thing could fly up high very quickly. So I decided to hold off on the trade alert today. As you know, I was looking for a trade today. We've got a development in the Ukraine-Russian war that's alarming and made sense to just stay put for at least another week, see what the retaliation will be. But basically, the US has blown up all of Russia's pipelines to supply natural gas to Germany as the German population was revolting, wanting an end to the war. So now there's no way for the Germans to get cheap natural gas from Russia anytime soon, and ensures the war escalates. We'll talk about why America wants this. That's on the defensive side. And again, 14 shares of EUO. On the offensive side, we're long Ethereum with the Grayscale Trust ETHE, 57 shares. We've still got our tech shares. That's just a crazy price on FNGU, 648. We got 27 shares of FNGU. And then we have our big war hedge betting on oil. You could also call it the inflation hedge. And there's a lot of reasons to hang on to this into next year. With NRGU, 1 share. If we look at the asset allocation, it's pretty even. We're about 50-50 on offense and defense right now. And as soon as we can get some confirmations inflation is going to stop rising, I'm ready to get more on the offensive side, which would mean to load up on Ethereum and NRGU primarily for high risk. For the safe growth, we'll play a little safer with a bigger treasury position and a bigger Bitcoin position. So we'll cover both portfolios today. And remember, if you're a paid member, you can log into the membership area, punch in how much money you have to invest, hit calculate, and it'll calculate exactly how many shares to purchase. So call Dean now to upgrade at 505-322-7515. Okay, let's go through each trade alert one by one with all the most interesting new content we've collected week over week. Step 1, buy 19 shares of UVXY, your crash insurance hedge. Now, I don't think we're going to crash from here unless the inflation continues to be worse than it already is. Essentially, I think the bond market crash is over, inflation has peaked, and that we're highly likely entering the late bear market stage where we want to be getting very aggressive. So the late bear market typically lines up with the early recession. And that's because the stock market is looking way into the future. JP Morgan's Marko Kolanovic says the Fed tilt is becoming increasingly likely. Hawkishness is creating oversold conditions, specifically in bonds and in foreign currencies. That's where the real pain is. I don't think we're having the bond market get so upset over the inflation. It's getting upset over foreigners' currencies being devalued against the dollar because of too hawkish of a Fed. Real-time inflation is falling faster than the CPI is recognizing. And so this is looking for a bounce. Now he's pretty much always bullish since I've been following him, but very respectable guru at JP Morgan. Here's a look at the volatility index, massive amounts of call options. Typically, you don't get big crashes when everybody's ready for it. We have massive, massive short positions everywhere in every way you can possibly imagine, whether it's directly shorting stocks, directly shorting cryptocurrencies with futures markets, buying call options on the VIX, buying call put options on the NASDAQ or specific stocks. Everyone's loaded to the brim. And so we'll see. October 12th or 13th is the next CPI print for the US, and it will be a big moment in time. If that surprises too hot, then absolutely the market is ready for another leg down. If it comes in a little bit flat or down, get ready for a monumental, epic market squeeze into midterms, which is what I'm expecting at this point. Now, just in case, we always have a little slice of UVXY in the portfolio. Around 8 to 12% is a healthy amount just to blindly have. If you've done that and not seen the March 2020 lockdowns coming, which we did and predicted, the SPY dropped 25% in a single month, and the VIX UVXY went up 1,000%. So a 10% position in UVXY under the right circumstances can be extremely profitable. And what we've had is this very jumpy market slowly working its way down, and the VIX has not done the job we'd hoped for. It really works well in a sudden shock environment that drives prices up. And the other asset that typically saves your butt has also been failing, which is the treasury market. So it's been very, very, very difficult to make money. The only reason we have is been betting on inflation via Boyle and NRGU. And Boyle's looking attractive. I'm looking at putting that back into the portfolio. Now that Russia's ability to supply gas is basically shut off and terminated for quite some time, or at least dramatically reduced. Okay, so here's UVXY on the 1 month. It's up 18% in the past month. In the past 3 months, it's down 14%. It's really not been delivering that type of return we need to offset volatility. Now, reasons to be concerned. If the dollar index stays at this level, it can create damage. Now, I would say the damage is already recognized with the NASDAQ being down 30% and the bond market being down about 30% as well. So unless we think DXY is going much, much higher and yields are going much, much higher, probably too late. We want to prepare for the opposite. I'm expecting the dollar to fall, and that's where you want to get your bets on crypto. When the dollar index falls, cryptocurrencies skyrocket in value. Chart 11, the Fed hiking cycle ends with deleveraging events. Now, this doesn't point out all the times the Fed's pivoted and saved the market, but typically, if the Fed is too aggressive at fighting inflation, you end up with a big mess on your hands. So there's reasons to have that insurance. This is just a big look at history. Decades of war or decades of inflation have led to negative or flat returns in stocks. So the World War I, you had basically a flat stock market for about 20 years. Ended up with the Great Depression and of course the Roaring 20s towards the end of it. That then led to the Great Depression. And so if you were holding through all of that, you ended up with a 25-year recovery time, and then you entered into World War II. The next period is the 70s, where we had massive inflation. But what's important is we had a growing labor force. Okay, so we had a growing labor force, and we had a low debt to GDP. So I'm not so confident we're going to have a repeat of this cycle that lasted 16 years and it wrecked the bond and stock market. And that's when gold did really well. Okay, finally, here we are at today, and we're dealing with this inflationary force, which we'll take a good look at in this section of the portfolio update. Section 2, buy 36 shares of TMF, your deflation hedge. Essentially, that's what I'm seeing coming over the next 2 years, is a massive amount of deflation. The question is, will it be a stock crash that drives yields lower, or is it going to be a healthy economy and inflation's coming down and we get bonds and stocks going back up together, with both being extremely oversold, bonds being far more oversold, I think the most likely outcome is both are about to go up and that inflation is going to fall. Here's a look at the wealth destruction in global bonds. I think it's like $30 trillion. And this is causing problems for governments and pension funds. Now, this is a channel the 10-year has been trading in, and it's gone way above what I thought was even possible, to the point where it's going to be essentially making it very difficult for the US government to fund itself. So we'll talk more about that as we go through these slides, but it's extremely likely that yields are about to plummet lower. And again, it could be for good reasons, inflation's coming down, or it could be for bad reasons. The global economy is crashing, stock market's crashing, and there's a panic bid into the bond market. Now, if we look at returns where the S&P 500 was negative, dramatically negative, this is the first time in history outside of the 70s where bonds and stocks went down together. Central banks are facing an enormous problem, and it's extremely unlikely they're going to allow the bond market crash to continue from here. And we're already seeing two central banks flip. Bank of England's tiny, but perhaps a sign of what's to come for the ECB, the second largest central bank. And then we got Bank of Japan, the third largest central bank. It's already been in yield curve control for quite some time. This is the return of corporate bonds. And so over the last 20 years, they've made money almost every year. And when they did lose money, who cares? It was down minus 3.8 was the worst return. So it was very good setup. This year in corporate bonds, LQD ETF is down 22%. It's below the level we saw in the March 2020 lockdown crash. So the bond market volatility is extreme. We've only seen levels like this in March of 2020. At first, there was a panic bid to buy the treasuries, and then it began collapsing with stocks. And that's what finally made the Fed pivot and start this massive money making spree. So the central banks will absolutely protect their bond markets. They're far more concerned about that than their stock markets. Only time we've seen a worse bond market volatility was in the 2008 crisis. So we're getting to the point where central banks typically intervene and drive yields lower. Same thing with the liquidity. The liquidity has not been this dry since 2010 and that March lockdown. And so again, we're at an extreme, and rather than bet that it'll get worse, the more likelihood is that this is going to be reversed. Luke Groman says at current DXY levels, that's the dollar versus euro and a little bit of the yen, foreigners have 7.5 trillion in treasuries they can sell. And he's talking about what they can do to come up with dollars that they may need to either protect their own currency or to pay interest, which is denominated in dollars. So they can sell their treasuries to get dollars. They can sell their stocks to get dollars. And combined, it represents a massive percentage of our entire market. And when you look at what the Fed has, here's where it adds up to. Foreigners have 7.5 trillion in treasuries to sell. The Fed has 8.7 that they're saying they're going to start selling. And the US needs to raise at least $1 trillion to cover its deficit. So how on earth are you going to not break the bond market? So that's really where we're at. Now, if we go into a severe recession, that deficit's going to potentially double because tax receipts will go down. So there's a huge, huge problem here. The Fed cannot allow the bond market to crash beyond where it has currently. Otherwise, big problems will arise. So here's the big news overnight. We had the basically we had yields rising in the UK while their currency was crashing. Typically, currency goes up with the yield. And so they panicked and they began buying their own bonds. And so this created an overnight jump in the bond value of 27% as they are protecting that bond market. So Bank of England joins Japan. We now have 3 groups. We have the ones suppressing rates at the cost of their currency, Japan and England. The ones protecting their currency at the cost of their bond market. That's the US and Brazil. So we've got the US having this very strong dollar, but our bond market's tanking. Then we have the ones letting their currency and bond markets collapse which is Europe currently. Their euro is getting destroyed and their bond market's currently a wrecking ball. And so we expect ECB most likely to start buying their own bonds next. They're already doing it with Italian bonds, but they're not doing it across the whole spectrum. Bank of England intervention says they were told they were responding to a run dynamic on pension funds, a wholesale equivalent of the run which destroyed Northern Rock. Had they not intervened, there would have been massive insolvencies of pension funds by this afternoon. This chart's looking at when the 10 and 2-year yield goes negative, it inverts, and just look at what happens to the 10-year shortly after. It collapses. So we're looking at really once in a lifetime returns in bonds coming up. Stocks have been discounted, but bonds relative to stocks are very, very, very attractive. So we're getting ready to increase our treasury position here soon, especially in that safe growth portfolio. Here's a look at container ships. Just a year ago, it was just these outrageous costs, massive demand. And we can see the demand is really just collapsed, going from 10,000 for a container to be shipped down to 5,000. Now, here's the main reason why we can't let interest rates go up while the U.S. Continues to grow its deficit. Now, remember, they want to run $1 trillion deficit and grow it to $2 trillion over the next decade. And so for that to happen, if interest rates keep going up, it's going to make the amount of debt issuance become a spiral that drives these yields higher and higher and makes it essentially impossible without a massive devaluation of the US dollar. So that's one of the key reasons we don't want to be super bearish on bonds for very long. This 2-year bear market is historical and likely coming to an end. US Zillow rent index versus the CPI. So the rate of change of rent is falling negative now. So this will be good. It's going to take some time, but this was what was really the wrecking ball in the inflation print last this month that shot the core inflation rate up. So we had core inflation falling and going flat for about 6 months, and then that sudden jump, and markets did not like that. So in about 2 weeks' time, we'll get the next one, and I expect it to be falling. Otherwise, there's likely more volatility ahead. Here's the components of the CPI that were harming. Now remember, CPI core doesn't include food and energy, but rent is the primary driver, and then the wages. So we can see that rent has just been relentlessly going up, but thank goodness we can see the rate of change is falling here. And we're actually seeing the Case-Shiller index have the first negative print, I think almost in 20 or 40 years. So we're actually seeing falling house prices. Food inflation is not subsiding, but that's not part of the core. Services inflation has been relentless. But again, this is the lagging indicators. Here's a really neat chart. This is the change in household net worth. So we went and wiped out $14 trillion of household net worth. So people aren't going to feel as rich as they did a year ago, and likely they're going to start to slow down those purchases. So this is indicating not only that the CPI is going to fall, it may fall rapidly, much faster than people think. Here's the so the first decline in home prices in a decade. Excuse me. We had the 2008, 2006 to 2009 decline in housing prices as well. So everything's really telling us that the inflation is switching to deflation now. 30-year mortgage hit 7%, and the rate of change is unlike anything we've ever seen. These are likely going to top out and start falling as it crushes demand. Here's a look at TMF falling 22% in the last 3 months. Here's a look at the TLT. I was telling our members I didn't think it would be possible to go below 115. Yesterday we hit 101. So this is a massive problem for the Fed and cannot be left to its own. There's going to be a lot of reasons to push that back above 120, and I believe that we can see it hit at least 160 over the next 4 years. So TMF is 3 times the TLT, meaning we could be making 3 to 4 times our money on this play with a nice easy buy and hold. And again, this is all assuming that the inflation is going to calm down. Now we're seeing similar pattern in other bond markets. So LQD, so TLT is down the most, 7.25% 3 months. LQD is down 5.3 in the last 3 months. And the high yield junk bond ETFs down the least, which is almost comical. The higher quality product has the greater drawdown than the junk bonds, down 2.4. Let's look at some of the shorter term bond markets specifically. So we've got the 3 month just going parabolically up. This happens all the time, but what happens right after it? They top out and then they crash. So I believe we are essentially at the top of the rise and getting ready to top and then crash on yield. Here's the 2-year. This is what dictates what the Fed will do. And this has been beginning to fall. Finally, but this is after going up 32% in the last 3 months and why we continue to have a lot of pain in markets. Here's that 10-year trend way out of its trend line, but get ready for a vicious fall. Here's what it's done over the last 3 months, rise 18%. Steven says, why do you think the higher quality bonds are down more than the junk bonds? That's a good question. We're not playing the investment grade bonds or the junk bonds. So I haven't analyzed that too much specifically. What I am seeing is less volatility in Bitcoin than stocks, which is typically a sign that we're at a bottom. The Bitcoin will typically recover before the S&P 500 by quite some time frame. And so we're perhaps seeing this same trend in stock bonds versus government bonds. Here's that 30-year, same pattern, way off its trend, getting ready likely for a sharp crash to the downside. Okay, so here's one of the bonds the ECB is buying, the Italian bond, but they just had a right-winger, populist, religious woman take control, and the left stream media is going hysterical over this. So the ECB could very likely cut off the free money to Italy if they wanted. So we'll see how that develops. They're not happy about this development. And this is probably one of the more problematic bonds to look at. Perhaps Italy threatens to just not pay this debt to the ECB. Okay, so some of the other inputs, this is what would be way ahead of course, wages, rent, and services inflation. So lumber futures have crashed massively, and over the last year are down 65%. Copper futures crashed significantly, down 23% year to date. The crash is stopping, but it's not making some sort of epic return. Baltic Dry Index, epic crash and stabilizing, but of course not making some sort of epic run up. Wheat futures typically do well leading into elections, but that's still not making some sort of inflationary move to the upside. And so here we are with the CPI. Let's get ready for this to hopefully fall in 2 weeks. Another indicator of a bottom is when consumer sentiment gets to extreme lows, and we sure have that right now. Initial claims. Now this potentially would make the Fed happy is if this was jumping towards 300,000. So right now they're still worried that there's twice as many jobs as there are workers, and that this is creating wage inflation, which creates this dynamic where people want to keep spending money because they're making more, and switching jobs has averaged a gain in wages by 8%. So they do want to destroy a lot of the job openings to get that out of the forward guidance here. The yield curve inversion, again, typically is a time to bet that the long end's going to fall here. Okay, so that's our look at the bond market. Let's look at the dollar. Step 3, buy 14 shares of EUO, the quantitative hedge. If the CPI comes in pretty low, then we're going to want to quickly dump EUO and either buy TMF or ETHE. Those will be my two favorite picks. If you want to go high risk, bet on crypto. If you want to have a very surefire bet, buy treasuries. So expect safe growth to get very bullish on treasuries in the next trade alert, and expect high risk to get extremely aggressive in cryptocurrencies. So funny little meme, the US dollar killed the yen, killed the euro, it just wiped out the pound. So what's next? Now, interesting, it's primarily the G10 countries that are having the pain against the dollar. A lot of these commodity producing emerging market countries are doing quite well because they produce food and commodities. Here's a look at the dollar against foreign currencies. So again, this has done a good job at hurting the rest of the world in an attempt to export inflation out of the United States. So this makes our imports cheap, drops that CPI, and it destructs the demand in other countries. So their dollars or their currencies are worth less. They feel very poor, and the opposite for Americans. And that's really what this war in Ukraine and Russia seems to have been all about. More to that once we get to that section. What the big picture is with the Russia-Ukraine war. There is a document release that really makes this much more understandable. That I'll summarize for you once we get to that section. Okay, so here's the dollar index. Can it go higher? Sure. But most likely it's very close to topping out and crashing. I want you to note the high of the dollar over time has gotten lower and lower during crises. And this because of the growth of debt globally makes it unsustainable. So if you're a crypto fan, note right here, just this little section right here, we fell from 105 to 90, and you sent Bitcoin from 800 to 8,000, and then it kept going up to 19,000 before you finally crashed. I'm looking for a massive move to the downside as soon as the main factors driving the dollar higher reverse, which is going to be when the Fed stops hiking interest rates and slows down quantitative tightening. That's when we're going to see a massive melt up in crypto. And again, just a closer look at that. The highs during crises are getting lower and lower over time in the dollar. And that's due to how problematic it becomes for global debt, which is growing at an exponential rate. EUO is up 38% this year. If the ECB pivots before the Fed, the euro could crash another 10 or 20% against the dollar. So still some really exciting upside. So we'll look at what the CPI is. If it's very low, we will pivot out of EUO in 2 weeks' time. Okay, so there's the euro. Now it's $1.03 to the euro. Not long ago, it was like $1.20 to buy €1. So it's just devaluating at a rate of 17% year to date as their bond market simultaneously crashes. So Europe's in a lot of problems right now. The Japanese don't care. They want to protect the bond market over their currency. And this is depreciated 24% year to date. Now China is having to dump US assets to protect their currency. So one by one, all these foreign currencies are crashing against the dollar. And this is going to lead to a massive sell-off in US treasuries and stocks if the Fed's not careful here. So their goal is get the inflation to slow down and fall, and then to flip the switch before it's too late. Now the Russian currency is up 29% year to date because of all their energy exports and this energy crisis that we have created via a lot of different things. We'll talk about that in step 6. Step 4, buy 57 shares of ETHE. This is Ultimate Growth Product. Druckenmiller, one of the famous hedge fund investors, says cryptocurrencies could have a renaissance if people lose trust in central banks. And the central banks are going to have to bail out their bond market so these governments can keep running massive deficits. There's just really no way around it. Unless governments want to balance their deficits, central banks are going to be in this same problem over and over again. And Europe, not slowing down the fiscal. They want to bail out everybody because of the energy costs and keep the war mongering going on. The US is in the same boat. So we're planning to run a $1 trillion deficit and we most likely just made sure the war lasts for at least another year, which admittedly I was wrong about because I didn't understand what the intentions are of the US here. And I do think I do now, so we'll cover that step 6. Savon Henrik says, we've reached a unique time in history when Bitcoin is less volatile than fiat currencies and stocks for that matter. Or perhaps Bitcoin just front runs the markets. And so I do think we're essentially at the bottom. Cool chart, US dollar, your money divided by infinity. They'll just print to no end. Bitcoin only has 21 million. Now, Ethereum actually has less over time. And I think we'll potentially match Bitcoin's market cap. So you're going to make like 2 to 3 times the return on Ethereum than Bitcoin, if I'm correct. This cycle, I think we'll have another crash in about 2 to 4 years after reaching massive new highs in cryptocurrencies. And then I think Ethereum can overtake Bitcoin in the second cycle coming up. Now, this is an interesting chart looking at the returns of Bitcoin over time. As the market cap grows, the return has become less. In the first major bull market, you made 600 times your money. The second major bull market, which happened in very similar situations as today, honestly, you made 110 times your money. The next big melt up, you made 20 times your money. And so this is expecting we can make about 3.6 times on Bitcoin, which means Ethereum could potentially make around 7 to 10% or 10 times your money. So that would send Ethereum to $13,000. I'm looking at a range of 8,000 to 13,000 to predict a top in Ethereum in this next melt up. Now, are we too late to get into Bitcoin? This chart's showing you the adoption of technology, and we're just very, very, very early in the games. Now, what's interesting, if you go back towards the 1900s, these technologies slowly had adoption. As you move forward, note the adoption rate is extremely fast. And so if governments are going to continue to run deficits and central banks are going to continue to devalue their currencies by buying their government's bonds, this is about to go parabolic. So it's been a very painful, just short of a year holding crypto. But if you've been in crypto for long, you're used to it. And as long as you hold, this ends up playing out correctly because you can bet on people being corrupt in governments and spending money they don't have for all sorts of reasons. Okay, so some signals for crypto to be very bullish. We hit the 200-week moving average. That's only happened 4 times in history. It touched it twice in 2015 and 16 before making that melt up. Touched it once in the March crash 2020 and then melted up. And we touched it not long ago. Same thing with the RSI reading, but there's even less signals to buy it. Worst month ever, worst quarter ever. The blood's on the street. Buy that cryptocurrency with confidence. This is looking at the yield you make in each S&P 500 sector. The highest yield you can make is in energy. We're already trading energy companies at the highest valuations they've ever had in the last 20 years. So you're not going to double, triple, or make 10 times your money buying ExxonMobil if you're looking for a nice dividend. Ethereum absolutely could make 3, 5, 10 times your money, and it's paying out 5% dividend to stake it. So it's just a tremendous opportunity to be going long Ethereum. Here's just a look at debt, just in case you're worried that we're not going to keep growing debt. Very, very rarely have we reduced debt, and very rarely have we just kept debt flat. And that's because the whole system relies on exponential growth of debt. Here's the US federal budget deficit projections. And of course, they always underestimate spending. But even with the underestimate, we're looking at getting to a $2.3 trillion deficit by 2032. And this is just showing you the exponential rate of increase of debt issuance in the US. Okay, so Ethereum is down 57% year to date. ETHE is down 64. So that difference right there is called the discount window. So you can actually get a 7% discount buying ETHE compared to Ethereum itself, assuming that discount window will close. Not guaranteed to, but it could. Now we like ETHE for beginners because you buy it in your stock account and you don't have to worry about security or getting hacked. It's very easy to do, but there's better ways to do it. We have a project called a private equity offering called Rebel Dividends. It buys Ethereum, plus it buys the altcoins. I'm buying altcoins that from 2018 to 2020 outperformed Ethereum 10 times. These are the software applications being designed on the Ethereum operating system that's going to make Ethereum successful itself. So think of Ethereum as the Windows and the applications that are being designed on it as the altcoins we're buying. So with Rebel Dividends, you get about $1.50 of exposure right now for every dollar you invest in Ethereum, but you're diversified into the top projects. So this is only available to paid members of Portfolio Builder. It's designed to replace your ETHE or your GBTC positions. Call Dean to learn more about it. It also includes a weekly dividend, which has been very, very good. 505-322-7515. Okay, step 5, buy 27 shares of FNGU. Last night, Apple signaled a slowdown. Their new iPhone's basically the same thing as the last one. There's pretty much no changes, so it's no surprise there's not a lot of hype about it. But today, about every stock is up except for Apple. Kind of funny. So here's a chart just looking at some statistics. The S&P 500 down 6 days in a row to a new 50-week low, had a 90% success rate of a 20% return in 12 months. That's looking at all the points in time. Now, it wasn't necessarily the absolute bottom at that moment in time, but when you look a year ahead, you had an average return of 20% with a 90% positivity rate. Now, the thing here today is we need that CPI to be flat or down, preferably down, for that type of market action to close out the year. Consumers still spending more and more each month. That has not reversed yet. Now, with the dollar going up about 15 to 20% against every currency in the world, at least in the major currencies, we're seeing less balance of trade. So that indicates less inflation. We're spending less to get more goods. Retail sales, they revised that negative print to be positive. So the US consumer is still very hot. So we're not expecting some sort of collapse in the earnings per share of corporations. Consumer credit continues to grow. Bank credit continues to grow. And the US stock buybacks are looking at hitting a record this year of $1.2 trillion. This is looking at the percentage of people taking higher than normal risk. Now we're at an all-time low. This is lower than the bottom of 2008 and 9. Likely a very good signal to buy. The returns per decade of the S&P 500, essentially the Great Depression and the 2000s were your only negative returns. Outside of that, just buying and holding was very profitable. Put to call premium is extreme, massive amount of hedging going on. People are very momentum based and they just think what's happened will never stop happening. So we can see the setup for a short squeeze is just massive. Midterm years tend to bottom later in the year and see larger corrections. Average return a year later from the bottom, assuming we're at the bottom, is 33.5%. That said, FNG is a screaming deal today at 663. Just last December, it was trading at 45 bucks. So just a massive loss. This is 12 giant tech companies, 2 out of China, 10 in the US, all of which have monopolies in their respective marketplaces, and you're getting them at 3 times leverage. So I'm going to move this to the safe growth because it's monopoly companies that are super safe long term, and high risk will focus on Ethereum. Some returns on major indexes. SPY is down 20%. The NASDAQ's down 26. Emerging markets is down 26. This is looking at when emerging markets has outperformed US markets, and it's about every other cycle. So I'm expecting emerging markets to outperform the US in this coming cycle. This will be really helped with a falling dollar and falling yields, which we're highly confident is in the books. So for the safe growth strategy, your EDC, leveraged emerging market play, which has been obliterated, is probably getting ready for a massive melt up. We do expect to add some exposure to that as well. EFA is the European index. If this were falling much faster than the other indexes, it would be of concern. So far, it's not. Some other plays we're in are uranium. This has been outperforming some of these indexes, but still down 18%. Rare earth metals, negative 21. Amazon, now we're looking at specific leaders, down 27% year to date. Apple down 14. Alibaba down 37. Okay, so here's the non-farm payrolls. These still keep printing at positive levels for how we're positioned. We really don't want it above 350. We love some prints that are sub 300, sub 200. The worse the payrolls go, the better the stock market's going to behave, because it's going to really be one of those key signals that the labor market's easing, and that's what the Fed's looking at for long-term deflation. Banks keep lending money, so there's no sudden drop in credit in consumer or bank credit. Consumer credit grew again, 23 billion. We actually updated that, so I'll delete that slide. Now, this is a surprise. We had falling housing sales. We had a little drop in prices. We got these outrageous interest rates now, and then a big jump. Fed's not going to like that. That was not a print signaling deflation coming in. Chinese PMI has been falling for 3 months. Exports have been flattening out. Imports have been flattening out. So that shows healthy economy, but not an overheating economy. Okay, step 6, buy 1 share of your war hedge. So what the hell is going on with Russia, Ukraine? It seems as simple as this. The US wanted to weaken Europe, specifically Germany, and make it impossible for Germany to essentially become under the control of China and Russia, where it gets its energy, and China, who it exports its goods to. So mission accomplished. Germany will no longer get any energy from Russia. So that was part 1, control Europe. Part 2 was to try to take all the resources from Russia. They have a massive amount of natural gas and oil and coal and every mineral you can imagine. So that's really one of the big reasons for the war. And the third was to prevent China from its 5G Huawei rollout and taking over Taiwan. And I'd say overall, they have succeeded in all of these goals. And perhaps the other main goal, which seems counterintuitive, is to get inflation to crash. So by crashing the European economy, it's really helping reduce demand. Now, the first reaction was that spiking oil price, which took oil to 134, but now we're trading at 85 to 90. So that has taken care of itself with the demand destruction from these high prices. So that's really what I see as the big picture. We had Germans protesting the war. They want their cheap gas back, and now that's simply not possible. Someone went and blew up Nord Stream 2, and it was almost certainly the US. In fact, I can't read this out loud or the Google will ban us. So anyways, that's my take on what happened. Prime Minister of Poland pretty much said that's exactly what happened, and actually thanked the US online and Twitter, of all things. So what's happening in the war? Putin is mobilizing 300,000, and they are making the little territories they've taken over part of Russia officially. This will probably be legalized in the next week or two. If Ukraine starts to attack those, they'll be able to get very, very aggressive with much more dangerous weaponry. So expect the war to ramp up. US making a ton of money exporting its natural gas from this, probably close to as much money as we're lending Ukraine. These are loans, not just free money to them. So what comes next? Potentially a spike in oil. So I like playing NRGU because of a few things. So here we got China could stop doing this lockdown policy, which I believe was to keep inflation lower in China. Russia and Europe could start messing with Russian exports. We've got the Saudis and Russia already talking about reducing output to drive prices back up, and the SPR release is about to end. So there's a lot of catalysts for, and plus if the Fed pivots, then the demand for energy is going to go back up. So energy could be very, very interesting here. So Ukraine needs to attack Mariupol to split the Russians in half, and that would be a huge victory for them. And that's why Russia rushed out to make this official Russian territory with a referendum, so that they could get very, very aggressive if Ukraine were to do that. So this looks like it's about to get much worse. Now, what's Russia's ultimate goal? It looks like they, according to Peter Zahan, most likely want to take this whole block of countries and really monopolize energy to Europe. And the West does not want that to happen. So NRGU, darn it, we could have sold it at 550, bought it back. We missed it. I was telling everybody we'd sell at 600, got greedy, but I believe it's going back to well above 500, perhaps to all-time highs, depending on how bad this war gets. So plan to hold NRGU through winter almost certainly and into next year. Here's a look at Brent oil at 87, very profitable at this level. The SPR is supposedly be refilled at 80, and the Saudis will cut output if it goes below 90. That's in like a week or two, and they're already signaling they will do that. So they're trying to keep that price up. So Exxon sitting at nearly record evaluations, and if oil's going to go higher, then they're likely going to break to a new high. Okay, this is where your video ends. If you're not a paid member, call Dean to upgrade at 505-322-7515. All right, we're going to jump into the exact asset allocations per strategy.